اوكي، بسم الله الرحمن الرحيم. الحمد لله رب العالمين، والصلاة والسلام على سيد المرسلين وعلى آله وصحبه أجمعين. Today I have the pleasure to introduce our Professor Aliyu from Nigeria to talk about a very important issue, which is the financial inclusion. Financial inclusion became a very well-known objective of all financial systems around the world. But he will talk about the Islamic financial inclusion in an area in Nigeria, in the northwest of Nigeria. And I hope that we will benefit a lot from Professor Aliyu. Professor Aliyu is an outstanding professor of economics in Nigeria and abroad. I have the pleasure to introduce him to you today to talk about this very important subject. Let me give you very short bio data of his experience. Professor Aliyu was born in Rano. This is a city in Nigeria in 1967. MashaAllah. Long life, Professor.
MashaAllah.
And he got his PhD in 2002 from Bayero University in Kano in Nigeria. He is a professor of economics in the University of Bayero, which he joined as a lecturer or assistant teacher in 1992. Congratulations, Professor Aliyu, for the 30th anniversary year.
MashaAllah, thank you.
So, MashaAllah, now you completed the 30th year in this well-known university. Congratulations.
Thank you, sir.
Long life for you and for the university.
Inshallah, inshallah.
Alhamdulillah, you were very active in community participation. MashaAllah. And also you were active in faculty and university committees and responsibilities. This is very rare in a teacher in university, but that is great, alhamdulillah. You performed a lot of assignments in national and international levels. I read your 26 pages of CV, and I learned a lot from this CV, because very rare of people register what they are doing. I am one of those who failed to register what they are doing. But alhamdulillah, I learned a lot from your writing of your great CV, mashallah. MashaAllah, you published 14 books and edited manuscripts. And you published 29 articles and 19 joint publications, MashaAllah. You attended 34 local and international conferences. MashaAllah. You had 21 unpublished works and has 18 external assessment readings and professorships. MashaAllah, you supervised 22 masters and PhD projects. Alhamdulillah, you have been examining 15 studies and 45 dissertations and theses. You are, alhamdulillah, very active member of 5 professional bodies in Nigeria and outside. You got, alhamdulillah, 8 prizes for your great job you are doing in your career. Congratulations, Professor, and we welcome you. It is an honor for our institute in Jeddah, who is the first research institute in Islamic economics around the world, to welcome you today and give you this time of 45 minutes to present your topic. Thank you very much, Professor.
Thank you very much, my brother Omar Hafiz. And it's my pleasure to be with my brothers in faraway land, the land of all the Muslims, Jeddah, Saudi Arabia, Alhamdulillah. And I feel highly honored to be invited to present my little research in this renowned institute in Jeddah. I was invited by brother Dr. Al-Muttasim and through another friend of mine and senior colleague, Professor Awalu Haruna of Ahmed Bello University, Zaria. And I immediately submitted my paper, and he indicated interest that the Institute will want to give me an opportunity to make the presentation. And Alhamdulillah, we are here today for this presentation.
You are welcome, Professor.
Thank you. Let me, since I have 45 minutes, give a little background to the research. In the first instance, the paper on predictors of Islamic financial inclusion in the Northwest Nigeria, a preliminary cross-sectional investigation, is part of the research that has been that has received funding from the Tertiary Education Trust Fund in Nigeria since 2020. But because of lack of time, the research effectively took off in January 2021. And the wider study that is funded by the TED Fund is on financial inclusion strategy and livelihood impact of non-interest financial services in the Northwest Nigeria, a cross-sectional investigation. So having started, let me say the research attracted a funding of about $25,000 to $30,000, depending on which exchange rate you are using. And we started the research effectively in 2021, and Bayero University Directorate of Research, Innovation, and Partnership. So the large-scale research, which we said is on financial inclusion and livelihood impact, has been dissected by the team of the researchers, I being the lead investigator. My other colleagues are shared on the screen. There is Dallami Abubakar Hamid, and there is Shehu Farida Mohammed. So the three of us, although we initially started four of us, one of our colleague, a research member, left the services of Bayero University, Kano. And so the three of us have, using the pilot study data, we have, which we have administered in 2022. We collected this data from financial institutions offering non-interest financial services in Nigeria, in Northwest, the Northwest, which composed of 7 states. And so for the pilot study, we administered only 80 questionnaires, 10 questionnaire each from the 7 states. But Kano, because it's a center of commerce, is one of the leading centers, not only in Nigeria, but in Africa. We administered 20 questionnaires there, so making a total of 80. So we said, let's use the pilot data to test the validity of the instruments that we are using in the research. So out of the data analysis we had, we were able to write 3 papers. One, which is this one on predictors of Islamic financial inclusion. The second one, which is on determinants of takaful investment in Northwest Nigeria. And the third one, which is on impact of non-interest financial inclusion on livelihood of households in Northwest. So having done that, and with the opening for me to make this presentation, I really have and really appreciate this opportunity. And let me, as a caveat, just caution the participant to this dialogue that the paper is a preliminary investigation, and they should not have high hopes on hearing very advanced analysis, but that this is a modest presentation of our research on this particular area, largely drawing from experiences and evidences in the empirical and theoretical literature. So starting the abstract, which has been formatted in this way because we have submitted this paper for publication in one of the journals in Asia, which gave me this format for the journal abstract. The abstract starts with the purpose for undertaking the investigation. And we said the paper conducts a preliminary assessment of predictors of Islamic, which is non-interest financial inclusion in the Northwest Zone, which composed of 7 states, like I have said: Jigawa, Kaduna, Kano, Katsina, Kebbi, Sokoto, and Zamfara State. The methodology that we have used, we said, having seen wide application and exposition on both theoretical and empirical literature on the dimensions of financial inclusion, which is being categorized broadly into, on the demand side, into access to the financial services, the utilization of the financial services, the quality of the financial services, and barriers impeding access to financial services. This paper constructed 3 logistic regression models based on access to financing received by household in the study area, access through automated teller machine, which is ATM, popularly called ATM, and access to financial, non-interest financial services through the use of unstructured supplementary data, service data, which is the USSD code, the fastest means of sending money and receiving money. Our findings from this short or preliminary investigation, the results show that while access to financing logistic regression model outperforms the other 2 models, households' location and years of business experience were found to be statistically significant across all the 3 models, implying that those in the urban area and with more years of business experience in particular tend to be more financially included than their counterparts in the rural areas. In addition, and in line with findings in the literature, age of household and years of business experience are averse to the use of ATM card and the USSD code for banking transaction. Let me know, am I too fast or too slow? Professor Omar?
No, that's great, Doctor.
All right, so thank you. And the practical implications of the findings are that this investigation show that improved provision of infrastructure and increase in the number of bank branches in the rural areas are key to financial inclusion in the zone. These are pointers to the Islamic banks themselves as service providers, especially the Jaiz Bank, PLC, and the regulator, which is the central bank. Alhamdulillah, mashallah, we have Dr. Abdurrahman in articulating appropriate policy strategies to enhance financial inclusion in the Northwest Zone and the country at large. The originality is that the study is a pioneer attempt on an assessment of predictors of financial inclusion from the Islamic, otherwise non-interest perspective. That's to the best of our ability, and by what is available, this modest presentation is a pioneer study. Then the structure of the presentation is in 5 sections. The introduction that usually introduces the concepts that were used in the analysis, and the literature and theoretical issues, review of literature and theoretical issues, the methodology, which is section 3, and then the results, presentation and discussion in section 4, and then finally conclusion and recommendations. So permit me to say in the introduction, as has been said by the anchor of this session, that financial inclusion permeates global policy agenda and is instrumental to inclusive growth, poverty reduction, increased economic prosperity, attainment of sustainable development goals, especially in developing economies. This has been evidenced by the researchers that have been cited. And so many other pluses that we can achieve as a developing country have also been associated with financial inclusion. Financial inclusion ranks as one of the main risk factors for poverty, financial exclusion in this sense is ranked as one of the main risk factors for poverty worldwide, a brake on economic growth, savings, and credits. This is according to World Bank, according to BREC, according to Alonso and others as recent as 2022. Financial inclusion connotes increasing access to a wide range of financial products and services through either a formal or informal institution, according to World Bank and the Central Bank of Philippines, and EFINA, which is an acronym for Enhanced Financial Inclusion Nigeria, or as one of the institutions championing the cause of financial inclusion in the country. Again, Islamic finance derives from the Sharia principles, citing these chapters in the Holy Quran, Surah Al-Baqarah, Ali Imran, Surah Al-Nisa, and then chapter 30, verse 39, all which de-emphasize or which sanction on the prohibition of riba in Islamic dealings. It's an unbiased system with no inbuilt discrimination, and its products are available to all regardless of one's own belief, according to Muhyiddin 2011. And specifically, Islam explores all possible means that promote a balanced distribution of wealth. According to the chapter or the verse in the Holy Quran, the Almighty said, whatever God restored to his messenger and for the inhabitants of the villages belongs to Almighty God and to the messenger and to the relatives and to the orphans and to the poor and to the wayfarers, so that it may not circulate solely between the wealthy among you, which the emphasis here is on promotion of circulation of wealth. Islam emphasizes financial inclusion through two distinct features, the notion of risk sharing and wealth redistribution. And there are a number of instruments of wealth redistribution, waqaf, zakat, sadaqat, and so on. Again, quickly, if I should also read this slide, Islamic finance, otherwise non-interest banking and finance, is a decade old now in Nigeria. It started initially, although as a window in 1989, according to Aliu, and then a full-fledged Jaiz Bank in 2012, as was licensed by the Central Bank. Likewise, the Central Bank of Nigeria launched the National Financial Inclusion Strategy in 2012 and was later revised in 2018. So concurrently, when Jaiz Bank was licensed, the Central Bank also introduced the National Financial Inclusion Strategy. Among others, the strategy articulated the demand side, the supply side, and the regulatory barriers to financial inclusion. And markedly, Islamic finance in Nigeria has witnessed phenomenal growth with over 30 service providers, ranging from full-fledged banks, we have 3, non-interest banking windows, microfinance banks, takaful operators, and other Sharia compliant fund managers. Still on introduction, the studies on financial inclusion from conventional perspective thrive in the literature globally and in Nigeria in particular. We cited Adewale, Okoye, Adetilio, Adiola, and so many others, too numerous to mention. But as recent as 2022, Ozili in the Central Bank of Nigeria also wrote on conventional financial inclusion. Notably, using library-based research, also Shinkapi, Yahya, and Sani in 2019 articulated determinants of Islamic financial inclusion. It was a library-based research, not purely an empirical research. The developments in the empirical literature notwithstanding, evidences show that in Nigeria is 14% away from attaining its set 80% financial inclusion target in 2020, or by the year 2020, and which leaves 36% of Nigerian adults, which is equivalent to 38 million adults, according to this finding by EFINA, to be financially excluded, and which unenviably ranks the country higher in terms of financial inclusion, enhancing financial access by EFINA in 2021. Furthermore, only about a quarter of Nigerian adults are considered to be financially healthy. That's about 27%, while 39% are coping and 34% are financially vulnerable. This underscores, therefore, the need for this investigation, meaning we have made an attempt to show the gap in the literature, both theoretical and empirical, and then we have situated the need for this investigation on predictors of financial inclusion. What does the literature say? The literature in financial on this very broad, large area, that financial inclusion is just about enhancing financial access by individuals and enterprises who previously were not within the financial system, either through a formal means or even if it is within the informal means. And in practical terms, the concept goes beyond the single using just a single indicator. And then 3 dimensions which have been mentioned in the abstract statement highlighted the access, the usage, and the barriers. This is according to also evidences in the literature. Another dimension of financial inclusion has been added, which is the quality of the financial services provided. When we talk of access, whether people are having access, and usage, whether they're utilizing it, or whether there are hindrances to accessing the financial services, also the concept of quality of the services provided has now been also added as a measure of financial inclusion. Which theory guided the theoretical underpinning of this study? I found this threshold decision-making theory very apt and a very appropriate theoretical foundation that we used in this investigation. The threshold decision-making theory has been widely applied. It's interesting that in the field of medical sciences, in agricultural sciences, and in virtually all fields, areas that involves decision-making, this theory has been widely applied. For example, what I saw in the literature, in a medical profession, the decision whether to adopt a particular diagnosis or maybe treatment is a threshold decision between whether to adopt this particular medication or otherwise. In agriculture, it could be used to as a bridge, whether we adopt a particular farming or instrument or farming technique or otherwise. So also, as is applied here, and extrapolating from the theory, that when individuals are faced with the decision to seek to be financially included or not, in a threshold inherent in them, which is dependent on set of factors, where these factors could be the exogenous factors. Thus, at a given level of stimulus below the threshold, individuals will not seek to be financially included, while at a critical threshold, the desire to be financially included is stimulated. And this is also, as is evidenced in these citations that were made. The evidences from the empirical studies that we have reviewed included that of Sheikh et al. In 2017 in a study using OIC countries, and that showed that the low level of financial inclusion was largely due to the Muslims' voluntary exclusion of interest-based financial services. And then other by Abdul et al. Using probit and logic models, they showed that households in the OIC countries in sub-Saharan Africa with Islamic banking and finance are more likely to be financially included than their counterparts without Islamic banking and finance. And their key drivers of financial inclusion in the sub-regions are age, gender, income level, level of education, and others, as the study found. Breck in 2018 discovers that, among other, a correlation between strengths of religiosity and interest in Islamic banking was established in Norway, meaning there is a strong relationship, correlation, although not deducing, not indicating explanation, but there is correlation between one's own level of attachment to religion and his interest on using Islamic financial services in Norway. Others include ACTA 2019, using a panel comprising of Asian and African countries. The study reports that Islamic banking has significantly contributed to the demand side determinants of financial inclusion. Ali et al. 2020 showed that the level of Islamic financial inclusion in Indonesia is influenced by both supply and demand side factors. Kamus, Abdullah, Othman, and Qasim, and another study also in Indonesia by Triento, all these have made significant contribution in the empirical area. What have we learned from the review? That the review reveals an array of predictor variables applied in assessing different dimensions of financial inclusion. One of the guide or indications that you have when you review literature is to be conversant with the predictor variables or explanatory variables that are used, and to select among the ones that data is available in your own study. Evidently, most of the studies were largely in Asia, Middle Eastern countries, and some few others in Africa, including in some of the final studies, a sample that composed of Nigeria. Nevertheless, literature documented the library-based studies by Shinkafi, which I cited in 2019, and on their part, another study by Kabir and Ibrahim included Nigeria among the OIC countries in their study. Adewale, however, used conventional indicators of financial inclusion among Muslims' household. So it is not Muslim, it's not Islamic financial inclusion, but his sample is Muslim household in Ilorin, Kwara State, in northern Nigeria. Thus, from the review, none of the studies reviewed assessed predictors of non-interest financial inclusion in Nigeria, and this presents a gap that this study seeks to fill. Then our research methodology. I don't have to repeat that the study is in the Northwest, comprising of 8 states, and we administered 80 questionnaires. We have leveraged on the application of standard logistic regression models by numerous researchers in the literature, and we employ Logit model to analyze the effect of financial inclusion on household in the study area. Sorry, not to analyze the effect, but to assess the predictors of financial inclusion. That was an oversight on this. Then logit analysis regression is the natural complement of ordinary least squares method, the OLS method that we know. Whenever the regressant, the dependent variable is not a continuous variable, but in a state which may not hold, or a category, or in a given classification according to Kramer 2006. The specification of the generic model is given in equation 1, and then where usually the Y is the dependent or the regressant, which stands for when individual makes choice to be financially included, and otherwise 0 when he chooses not to be financially included as is indicated. And from the equation, Y equals to 1 if X is greater than or equals to a critical value of X, we say X star, and Y equals to 0 if X is less than the critical value of X star. And this is in line with also the threshold decision-making theory, which I've highlighted at the theoretical underpinning for the study. The equation further represents a binary choice model involving the estimation of probability of household being included in the non-interest financial institution in the Northwest Nigeria, given set of factors X, such as age, gender, marital status, religion, level of education, among others, that are exogenous and associated with household, a particular household I in the sample. These are the equations that we have used or which have estimated after we formulated them with the specification of the dependent variable, access to financing products. That is not just enough to see if a customer or a household opens an account with a non-interest bank that is simply financially included, but we said, let us find out whether he has accessed any financing, either in form of murabaha or ijara or musharaka or any funding received from the bank. So this is the equation that we have formulated. If you read the main prose form of the paper, this is equation 7. And because of large number of variables, we created 2 equations for this model. Equation 7a to capture some of the exogenous variables, and equations 7b to capture also other factors that could influence households being accessing the non-interest financial services by means of financing from these institutions. Another equation or model is also for the use of ATM card, sorry, which will also have 2 equations, the equation 8a and equation 8b. We have specified and later defined all the variables that we have used, gender, marital status, household size. Household size, the square of household size will tell us whether there is non-linearity in the model, whether at certain threshold size of the household, whether we can witness a declining or a change in the attitude of the household towards accessing financial services, location, and years of business experience, as we've shown in equation 8a. Also, equation 8b mimic equation 7b in terms of the number of variables that we have used in the model. Equation 9a and b are for the use of USSD code, which a household, when he is using the code, is 1, and when he's not using it, is 0. So, and the variables also have been identified as specified in these 2 equations. This is the definition of the description of the variables and the justification for using them in the models, the 3 models that we have. All this is about the description and justification of the models, the variables, sorry, that we've used in the specification of the models, and then the preliminary results, the pre-estimation, the pre-estimation test involving the use of Cronbach alpha for all the instruments that we've used for all the variables, and then the overall test score of 0.62, which if it is anything above 0.6, we can go ahead and use the particular instrument in the model. Otherwise, we should not. This is the results for the first model using, because of the size of the results in the main paper, the prose form of the paper, you can see that this is presented in one table, but I have created 2 tables to show for model 1, the coefficients that are significant from this, as we can see, is largely marital status, the level of household education, and there is indications that the higher the level of education from secondary to diploma And to HND, the higher the level of education, the higher the impact of as a predictor on determining non-interest financial inclusion access. The interpretation is that, yes, for model one, married people have lower log of odds of accessing financial service compared to unmarried or single by about minus of 2.4 units and an odds of 0.09. Higher qualification generally negatively correlates with access to finance by up to negative of 4.2 units of odds, and which intuitively we said this could be explained from either side of the coin. Either with higher qualification, household have higher income or earn higher income, and so do not necessarily need financing from non-interest finance banks. Or higher qualifications mean higher economic and social responsibility, and therefore could prompt the household with higher qualifications to go for non-interest financial services. Although income does not play a significant role in determining access to financing in the model, household size does. The higher the household size, also the more it negatively affects financial inclusion. Equally, household location, those in the rural areas matter for access to finance. Those that are mostly vulnerable are those in the rural areas. So giving them access to finance means lifting them out of financial difficulty and raising, as we have found, raising their livelihood in terms of meeting the livelihood indicators of consumption, income, savings, wealth acquisition, and so on, which perhaps is maybe revealed by the other paper, which I said is one of the three that we have found, we have achieved from this pilot data. The model 2 of the same financing, which is specified in equation 7b, has these results, and the interpretation of the results is on a slide after, which we said our second model featured 3 statistically significant coefficients at the 10% level or better. Some are significant at 5%. Nearness to non-interest financial institution, nearness of non-interest financial institution to working place, duration of household with the non-interest financial services, and years of business experience of customers of household are all significant in addition to the intercept. The findings in the 2 models, summarizing model 7A and 7B, we generally found support in the literature for these findings by Abdul, which is, we say Abdul et al., Abdul Jibril, Abdullah, Rabiu, 2018 in their final study, which we showed, Triento et al., 2021, and Abdullah, Othman, and Qasim, 2021, both in Indonesia. However, Kamus Besim in 2020 in a sample comprising of MENA, Middle Eastern, and North African countries found that education, among others, does not affect financial inclusion. This is for financial inclusion through the use of an ATM card. I have merged the 2 models here, meaning for equation 8A, which was specified earlier, which is for model 2. The findings are here. Among the significant, sorry, I'm having some challenge. Household size, household location, years of business experience, the checking for, the square of years of business experience, and the constant in this model 1 of 8A, and time taken to reach the service provider, which is the non-interest bank, here is significant. Income and duration, number of years that a household has been operating an account with the non-interest bank, and the constant are all significant in these models. So we said, in line with the intuition, household size is significantly affects log of odds of using ATM for banking service by about 0.67. For non-linearities that we've said, the squared effect of or coefficient of the household size was found to be negative, meaning after a certain level, the size of the household negatively affects the use of ATM card for accessing for banking transactions in non-interest financial institution. Also, household location increases the log of odds of using ATM, but years of business experience negated. Sometimes the more the number of years, the more perhaps the business enterprises feel it is unsafe to use ATM card for banking transaction. In our second model, nearness to non-interest financial service provider to working place, distance, which in the form of barrier, number of years of banking experience and income are all statistically significant and were found to be correctly signed. Generally, our finding in the two models support Abdul et al. In OIC and Akhtar et al. 2019 in Indonesia. And then the third model specified in equations 9a and 9b, the results are here. The significant coefficients are age, income, the square of income, although having highly merely small coefficient, and household location, household size. And then the second model, we have duration with the non-interest financial service provider, the squared of the duration with non-interest financial service provider, and the square of also the years of business experience. In all, we have used here 64 observations, which have not maybe indicated in earlier. Out of the 80 respondents, some of the households do not indicate the use of the USSD code, so that was why the number dropped from 80 to 64. So age of household is averse to the use of USSD code for banking transaction, which is, we can say, partly support what is happening. The aged household may find it difficult to use and to even be conversant with the IT, the use of the IT instruments in using this for banking services. Income of household in both nominal and squared forms are statistically significant and consistent. Urban households have higher log of odds of using USSD code for banking transaction than their rural counterparts. Higher family size lowers the log of odds of using USSD code, perhaps because of low income or low amount in the accounts. Household duration with non-interest service provider in both nominal and squared form bounds with statistically significant and correctly signed coefficients. And similarly, the years of business experience in squared form is robustly significant and correctly signed. And this is supported by the evidence of the research by Abdul and Akhtar and Hamus and Besim, which has been earlier explained. Quickly, guided by, in our conclusion, guided by the threshold decision-making theory, the paper constructs 3 logistic regression models using demand-side dimension of financial inclusion, access to financing, use of ATM, and use of a USSD code for effecting financial transaction in non-interest financial institutions. The paper found that while model of financial access outperforms the other 2 models, rural households exhibit more desire for financing than their counterparts in the urban areas, which is natural. because of level of financial exclusion that largely permeates the rural dwellers. Further, household location and years of business experience remain robustly significant across all the models, implying that those in the urban areas, coupled with more years of business experience, tend to be more financially included than their equals in the rural areas. Maybe lack of business expertise and lack of maybe household access to these services in the rural areas. There are still challenges in having branches establishing their banks establishing their branches in the rural areas. And then lastly, in line with the intuition, however, age of household and years of business experience are passed to the use of ATM per account. The last slide is our recommendation. We recommend that to extend financial access to, in the rural areas, the non-interest financial service providers, and in particular, Jaiz Bank should continue with the strategy of cross guarantee. The bank pull together those seeking for financial services, especially through cooperatives, to guarantee each other so that there will not be default in the transaction. Collaboration with donor agencies, the capacity of small businesses and customer literacy or facilities should be enhanced to protect households against fraudsters and financial products and services to cater for their financial needs with minimum distress. Thank you, my brothers, for listening. And the chairman will now take over for this at this juncture. Thank you. Assalamu alaikum wa rahmatullah.
Alaikum assalam wa rahmatullahi wa barakatuh. Thank you, Professor Aliyu, very much for this very fruitful presentation and very informative. Allow me to start the discussion with you by asking you general questions about the calculation method you are using to calculate the financial inclusion. If we stick to your definition of Islamic financial inclusion, that it means in two ways: risk sharing and wealth redistribution. Is this taken into consideration in the calculations, or the conventional way of calculating the financial inclusion is used? Thank you very much. And we will take the comments and questions from our audience today. Thank you, Professor. If you like just to shed a light on this one.
All right, I should do that now, or I should take other comments. Maybe I should do that because it comes from the chair. Quickly, the concept of risk sharing and wealth redistribution. We said the institutions that are the non-interest financial institutions are the ones largely in taking the risk sharing and the wealth redistribution. So also the customers that also partake in musharaka transaction, in mudaraba transaction, which are all form of partnership. If a customer deposits in the bank, there is they call it for current account, they call it current maybe benevolent loan to the bank, which is a liability to the bank. And if the customer opens an account in savings account, it is either in the form of direct musharaka or mudaraba or ijara. They have different accounts. And so this ways, the financial inclusion aspect of Islamic finance have been taken care of by the relationship between the household, who are the customers, and the bank, either in the form of the facility beneficiary or depositor with the bank. And the bank itself embarked on benevolent also financing and other charitable maybe transactions or giving of money at no interest, and then other social corporate responsibilities that also promotes sharing of wealth. But perhaps this was a view expressed by one of the researchers. I think, is it Mohieddin, that said this could be viewed as one of the perspectives of understanding financial inclusion. But the literature, largely from the other side, analyzed the demand side, the supply side, and also the regulatory aspect. The demand side largely is what this paper used in its analysis. And even within the demand side, we have restricted to only 3 indicators: the accessing of finances from these banks, non-interest service providers, the utilization of or the use of ATM card, and also the use of USSD code. There may be other demand side factors or determinants of inclusion that we have not used that are available there in the literature, if I may quickly say.
Thank you, Professor, very much for the clarification. Now we open the floor for comments and questions from our brothers and sisters attending this dialogue. Yes, please raise your hand to speak, and we'll give you the choice to add, to comment, to question Professor Aliyu. Yes. Any volunteer? Yes, Dr. Abdurrahman. Please unmute your microphone. Yes, brother.
Thank you, Chairman. Thank you, Professor Rano, for this your good presentation. It's a well presented paper, and I just have a question and then a small explanation. In your explanation on the current and savings accounts, I think there was just a small mix-up. Actually, savings account is the Qard Hasan to the financial institution because it's guaranteed and it doesn't generate any return. But it's the current account that you can put in either Musharaka or Mudaraba and so on. So that is just the clarity. And then second, my question is in the methodology, you said you use a pilot study and then 80 questionnaires for the study. I think for a pilot study, 80 questionnaires are very sufficient, but I don't know whether, sorry?
Yeah,
80 questionnaires are very sufficient for a pilot study. But my understanding is you use pilot studies to validate your questionnaire, and then after validating it, you now update it and then conduct another study, which will be for the main study, which will have at least 250 or more questionnaires based on literature. So I don't know whether you intend to do this going forward in order to make the findings of the study valid, because with 80 questionnaires, you may not be able to have valid, just from my own understanding, valid results for this area that you are covering, which is
you mean the size of the sample is very limited?
It's very limited, but for pilot study is okay, but you do pilot study to update your questionnaire and then go back to the field and collect more samples, at least from the literature, maybe 250 and upwards of that, and then conduct a study so that it will validate your results. So that is just my observation. Thank you very much. Because when the sample is very small, then the results will be questionable. Thank you.
Now we receive another comment from Brother Muhammad Ishaq. Yes, brother.
Assalamu alaikum wa rahmatullah.
Alaikum salam.
MashaAllah, I thank I appreciate the effort of the presenter and the co-authors, and I pray to Almighty Allah subhanahu wa ta'ala to increase them in knowledge and wisdom. The observation that was just raised by the previous speaker, I think he said that Prof has mixed up his presentation concerning the two accounts, saving and the current account, saying that it is the current account that could be based on musharaka or mudaraba. I think it is a mix up from him. I think Professor put it right that saving account could be based on mudaraba, while the other account could be based on qarb hazard. Yes, I think the Prof has put it well, while the mix-up is from the commentator. So I think he can kindly take notice of this. Thank you very much.
Thank you, Brother Ishaq. Thank you very much. Now, any more comment on this issue? Brother Sultan Abdul Salam, please, you have 2 minutes only.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Alaikum salam.
For all, I would like to thank Professor Aliyu and his colleagues for conducting this research. Actually, I have a small question. Would you elaborate on details? How did you reach the second and third recommendation? Because it's not stated in the paper. Thank you so much.
Thank you, Dr. Sultan, very much. Any more comments? Yes, Brother Muhammad Ishaq, you like to add?
No, I think I have done my comments, sir.
Okay, so please change this the raising of hand. Okay, any more comments, please, brothers, sisters? Yeah, Dr. Hisham Hamza, are you available? Dr. Hisham? Okay, Dr. Abdullahi, I think he like to add something. Abdullahi?
Right.
Yes, brother. Abdullahi Yunusa? Muhammad Ishaq, again, you raised your hand.
Muhammad Ishaq, put down your hand.
Okay, if you get your hand not raised because... Okay. Yeah, Professor Ali, do you like to comment on what has been raised to you now?
Yeah, I want to comment quickly on what has been raised. Alhamdulillah, thank you, Brother Abdurrahman, Dr. Abdurrahman, for the 2 comments that he has made. One on the savings and current account, which Brother Awal Ishaq has responded to, and which still remains the case. Is for savings account that the banks will have the opportunity to invest either in musharaka, mudaraba, and other forms of Islamic contracts that would be beneficial and yield return to the household. Whereas for current account, just like in the conventional banks, current account do not attract interest until recently. And so also the form of the relationship between the bank and the customer is that of benevolent loan. The household giving the bank a benevolent amount, which it can use to maybe generate its own return. And the large-scale study, yes, I've said this is a pilot study for validation of the instrument. And we have also so far achieved, we have successfully administered 800 questionnaires, out of which we got over 750 were returned, and we have started the analysis. And we hope that from the analysis, not only would maybe compare, contest, and improve on the findings of this study, we will replicate re-estimating the predictors of financial inclusion. We'll expand on the Takaful paper, which I have mentioned. We'll also explore more on the livelihood impact of this non-interest financial inclusion on the households from these over 760 questionnaires that we have administered and which we have received and which we've so far started the analysis of the results. We also intend using the expanded data to even explore gender financial inclusion or exclusion and the ethical and moral behavior of households as they interact with the non-interest service providers, and also to expand, like I have said, this research. So we are open to so many opportunities of one, improving on the findings of these studies, and two, on exploring other areas that we have not, because of the limited size of the pilot study questionnaire, which we could not achieve. So that is that for Dr. Abdurrahman, and I thank him really for that. And the second person, Awal Ishaq, yes, he just made a contribution. And the third recommendations, on recommendations, we have presented 3 recommendations. One of our colleague brothers said, how do we justify making recommendations 2 and 3? We said in the course of conducting the pilot study, we have witnessed in some states, in particular Kebbi State, within the Northwest, that there were some NGOs that came in and partnered with Jaiz Bank in Kebbi State that were given financial literacy program on how to use or how to access and to use the financial services, and which empowers the households in the rural areas for achieving better utilization of the funds. Although it's not estimated really, it's not part of the instruments that are being estimated in the model, but we have used that knowledge, and which we hope to improve and incorporate in the large-scale paper while we are doing the analysis there. And but in particular, the literacy and security. Using ATM and USSD code require security. We saw that age of household is averse to using, and the years of business experience are averse to using these facilities, because mostly if you don't have knowledge, mostly we that are 50 years and above, sometimes when you are using our mobile phones, we even have to require or to seek assistance of our younger children to educate us on how we use it. So also these IT facilities, the banks, we are sending this message to the bank, and to be also to engage also in this campaign on educating the customers on this and the securities, and to ensure that at least fraudsters do not take advantage of the household illiteracy on these facilities and maybe fraud them or defraud them as they are using these financial services. So perhaps that's justified, at least in particular, the recommendations number 2 and 3, and even number 3 and number 4 is to do with the age and user-friendly financial services. Sometimes literacy, like we saw the coefficients of education of respondents, the higher the level of education, the more educated one is, the more aware he is of the financial services. And the nature of the financial transactions that are done in an open and transparent manner allows the customers really with higher complication to be able to understand the concept. When you mentioned musharaka, mudaraba to an illiterate person, a lettered person is very difficult for him to understand. But when these are maybe properly explained, the household and the customers will be able to understand and utilize these services without any hindrance and without any exposure to being maybe financially defrauded. So thank you, the ANCO, for the program. I think I've responded, except if there is another comment from the floor.
Okay, Professor Aliyu, I would like just to extend Dr. Sultan Abdul Salam questions to you. Now, in your recommendation, you are suggesting to Jaiz Bank to extend his services to the rural areas.
Yeah.
And this is a good recommendation, but why Jaiz Bank only? Why not you suggest more Islamic banks to be open in all areas? And the experience of Indonesia in rural Sharia banks is very rich because hundreds of these small Sharia banks are there to help in the financial inclusion. Please, what is your opinion about this?
Generally, it's a good thing to say all the non-interest, full-fledged non-interest financial institutions to open their branches. We perhaps have been carried away by the fact that Jaiz Bank has been the oldest licensed bank. If I should say this a bit, in 2016, I proposed to do this study, to undertake this study, which was just a barely short number of years. 2012 to 2016 was just barely few number of years for an assessment of the impact of financial inclusion, because some of the contracts, Ijara, Musharaka, Mudaraba, take number of years. So Jaiz Bank at that time was resistant to allowing us to use their customers for this investigation. So also when we were to do this research, there was a Taj Bank was licensed, and also Lotus Bank were also licensed. So when we wrote to them, we approached them that we want to use their customers for this study. Practically speaking, Taj Bank is just not up to 2 years, and Lotus Bank is barely 1 year. So they were reluctant to allow us to use their customers for this, because they know we may not have good results, and they fear that if we don't, we may blame the bank for that, which we are not likely to do that, which certainly we will not do that, sorry. So, but largely we used Jaiz Bank customers, we used Takapul operators, there is Salam Takapul, Jaiz Takapul, Nur Takapul, and we have used one pawn manager, Islam Sharia compliant pawn manager, Lotus Capital. So these are the institutions that we have used. But we hope that by the time we are making, maybe we are through with the large scale study, we'll open up the recommendations, and we'll not only recommend for opening of more branches of only Jaiz Bank, but also for other banks, and also for the regulators such as the central bank to do more to encourage rural banking in this particular industry.
Okay, thank you, Professor, very much. And I need to raise a question, but after giving the choice to Mr. Hussam and then Mr. Abdul Rahman. Yes, Mr. Hussam, please.
Assalamu alaikum.
Alaikum salam wa rahmatullah.
I have a thank you first, Dr. Aliyu and Dr. Omar, and here. I would like to ask a question about central bank digital currency, the e-Naira. Does it have any role in eliminating financial inclusion?
Thank you, Mr. Hussam. Brother Abdul Rahman, you like to raise a question now?
Yes, thank you very much. Just a bit of information to Professor Rano. Actually, Jaiz Bank will not give you the list of their customers because it's a regulatory requirement. So they are not allowed to disclose their customers for a number of reasons, including security and others. So that is why most studies on banks, they use convenient sampling. So they can't give you, because if they give you the list, which will be your frame, they will be violating some regulatory requirements. So that is why they did not give you. And no bank will give you actually. Then on the issue of opening up rural banks, I think we need to look at the reality. because of technology now, even in the urban areas, the number of branches are reducing. And it's not cost effective for them to do that. But we have a number of initiatives from the central bank in collaboration with the commercial banks and other non-interest banks, like agent banking, tiered customer, know your customer requirements, which reduces the requirements for opening an account, especially in rural areas. And we also have the agent banking, where the banks have agents in all the rural areas, both Islamic and non-Islamic banks. You can go in there, collect a form, open an account, make a deposit, and so that. And so they are agents of the bank. So they are there as representatives of the bank. Because of the current realities, especially the high cost of maintaining brick and mortar banks, as well as the advent of technology. So those are the things. So to ask banks to open branches in the rural areas now, to be very difficult, but using technology, they have been reaching out to a larger group of people. And then just to answer the last question, I know Prof will also talk about it. Actually, the eNaira is also one of the initiatives of the central bank to promote financial inclusion, where you don't need to go to the branch. You can have it in your mobile phone, which is just like one of the areas that the Prof used as his area of study, the USSD code. So eNaira 2 is part of that technological advancement that is being used to promote financial inclusion in Nigeria. Thank you very much.
Thank you, Dr. Abdurrahman. Professor Aliyu, do you like to respond before I put my question? Please. Dr. Abdussalam, you like to add anything?
Yes, Dr. Omar. Thank you, Professor Aliyu, for your response. Actually, what you have mentioned is right, and I agree with you. However, maybe you can add a small part about future research. If you put in the second recommendation, like a small note and defining exactly the benefits, or let's say the role of NGOs, and you sometimes name some of those supporters, like from donor agencies, and then this will open like a new research for those NGOs and donor agencies to see exactly whether they have effective instruments and roles to enhance the financial inclusion. That's all. Thank you so much again.
Thank you, Dr. Sultan. Thank you very much. Professor Aliyu, are you online? It seems a problem in Professor Aliyu.
It's like we have lost Professor Aliyu.
You rejoin, please.
Just give him a few minutes.
Yes, Abdul Hafiz.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Alaikum salam wa rahmatullahi wa barakatuh. Yes,
to add a question or to build on the other question.
Yes.
Just before, I think maybe Professor Ali, you can add limitations of the research undertaken, because I think there are some limitations in terms of the methods used, and also in terms of the understanding of the environment in which this study has been carried out.
Okay.
So I think it will be worthwhile to state limitations of the research that he has taken in his country.
Yes, thank you, Brother Abdul Hafiz. Professor Aliyu, before we close and I ask you a final question, please, if you like to respond to what have been now raised to you.
He has not rejoined yet.
No, Prof, you are muted. Professor Rano, you are muted. You have to unmute yourself.
Thank you. Yeah.
Thank you.
Please,
Yeah,
yes, now you
sorry,
are.
I've lost some I've lost connection, but I'm now fully back, hopefully, inshallah. So the comment, the information that Dr. Abdurrahman, brother Dr. Abraham gave on the use of list of bank customers. We have not approached Jaiz Bank to get their customers. We did our selection of sample by practically going there and by administering our questionnaire directly to the customers. What we only sorted for from Jaiz Bank was their understanding to allow our staff or our research assistants to be in the premises of the bank, which the bank graciously accepted. In addition to supporting our research financially, the bank also gave us this support of allowing our research assistants to access their customers, not their list, their information, but we have our one on livelihood impact. So it is that information that we used for this pilot study. And we thank the last contributor, Abdul Hafid, who said we should cite our limitations, which perhaps obviously we have missed that, because this is a preliminary investigation. We have to acknowledge that. And some of the challenges we have experienced of limited questionnaire, especially for the Takapul paper, which we've had much shorter information or number of respondents in the analysis than even in this one. So we thank all for this. The digital currency, Dr. Abdurrahman has responded that in addition to the drive on financial inclusion, it will also reduce the cost of the printing of the currency, the notes for use in the transaction. The digital currency is safer, it's more economical, and it can reach remoter destinations. Now that mobile phones, sometimes you don't have to require data to do this transfer or these transactions. And in form of extending financial services, really is not practically economical now for banks to establish branches, but through innovative means, mobile branches, Jaiz Bank has been establishing mobile branches and smaller units, recruiting people from local environment with not so high qualifications in administering these finances, especially for not so literate rural households and rural women. The sample, the questionnaire administration we had, which as researcher, maybe as lead researcher and other co-researchers, we went around to these states to see how these questionnaires were administered, and we have learned a lot, even by interacting with the customers directly in the course of questionnaire administration.
Okay, thank you, Professor, very much.
It is allowed to extend financial services. Thank you.
Thank you, Professor. Now
thank
we
you,
give
my brother Dr. Umar.
Okay, thank you very much. We give Brother Muhammad Jum'a. Brother Muhammad, please, if you have any short question to Professor Aliyu.
Naam. Assalamu alaikum wa rahmatullahi wa barakatuh.
Alaikum salam.
Thank you for the opportunity given to us to listen to this lecture. So quickly, like I said in my question, Nigeria has a very teeming population, youth population, in their millions, and they keep on growing. I'd just like to put to Prof that doesn't he think that with these young people with smartphone in their hands, that fintech is also another area to also look into as per to advance the cause of financial inclusion? And secondly, how does he think what needs to be done right now in Nigeria to harness the potential of Islamic fintech to really develop financial inclusion? Thank you so much.
Thank you, Brother Muhammad Jum'a. Yes, Professor, please take my question and then answer both. Is that possible?
Oh yeah, it's possible. What's the question, sir?
No, because this will be, we have just 5 minutes to go to end.
All right. No, so now, what's your question?
Yes, Nigeria as well as other countries are performing in the financial sector is in a mixed economy, which means conventional as well as Islamic banks are working there.
Yeah.
So to what extent this situation affect the calculations of financial inclusion?
Yeah.
Please take this also into account. Thank you very much.
Yeah, thank you. So responding to Brother Mohammed Jimo, the areas are diverse areas that perhaps we can approach and which we can study. This paper is not on fintech. It only touched lightly on ATM and USSD use of USD code. So we've not fully gone into fintech. You can see how someone was asking how did we recommend on recommendations 2 and 3. So we cannot recommend and we cannot say anything on how this youth bulge and or the large number of youth that we have, the use of fintech, how that can be used to improve extending financial, non-interest financial services. It's a room for further studies that you and me can consider maybe for future in the near future. But really, there are potentials for that. They are now more friendly with the technologies and even with their social relationship, active, real social relationships. So if you can engage the youth using what they are most familiar with, what they are always together with, that will help to improve financial inclusion, really. Having to do financial inclusion in a mixed economic system, we can say it is very much possible, just like we have financial inclusion in a purely capitalist system, Islamic financial inclusion in a pure capitalist Western, European, Asian, some non-Muslim Asian countries, imbibing and adopting and showing strong interest in financial, non-interest financial services, Islamic finance. So it's very much possible. And the perspective that we have for Islamic finance is such that even in Nigeria, there are for financial services provided by Islamic banks, more than the services provided by the conventional banks. We had about 2-3 trainings of staff of Central Bank of Nigeria. And when we mentioned other instruments of financial inclusion, the takaful, they're saying, well, is it possible? Is it possible that when I have not suffered any loss and my contributions will be returned to me? We said, yes, it's possible if you have wakala, if you have kafala, if you have this type of particular types, different types of takaful arrangements, you can have your share of profit and you can as well have your own contribution. So they said that is not possible in the case of conventional insurance. So also in Nigeria, the emergence, the operations of non-interest financial services have really opened and have been actively imbibed and well received by non-Muslims in Nigeria when they want to especially enter into agreement or financial transactions involving asset acquisition, ijara.
Hello, yeah, Professor Aliyo.
Involving financing, murabaha, so many non-Muslims as well. So
Professor,
I think that's
yes, please complete if you have anything to.
No, I mean, in terms of this, the arrangements that are offered, financial transaction arrangements are more palatable, more acceptable to non-Muslims than we ever imagined. All the agitations, the fears, the cries about Islamization in Nigeria died down when some states in the southeast that are considered to be aggressively against the introduction of Islamic banking have been receiving maybe patronage or have been patronizing Islamic banking. And interestingly, when the non-Muslims, the Christian, approached the central bank, why are they having Islamic banking as non-interest alternative. They said they have now recognized non-interest bank under Islamic principles, and they are open to registering any other non-interest bank under whatever system, if it is available. So the Christian Association approached the central bank with a proposal that they want to go and develop a proposal for introduction of non-interest bank under the Christian pace. So the central bank warmly said they are waiting for them to come back. So 2 years, 3 years, they are still waiting for them to come. They said the system must have been applied somewhere in the world, and which I believe it's not possible to have such a system that has been applied using any other alternative arrangement than the Islamic Sharia principles. So thank you, my Prof.
Thank you, Professor,
my
very
pleasure.
much.
Yes.
It was my honor really to coordinate this dialogue and have you here with our great attendees to this one dialogue. I'm very sorry to Mr. Adam Umar because time now is over. And we hope to meet in the next dialogue, inshallah. Thank you, Professor, very much.
Thank you.
All the best for you and the attendees. سبحانك اللهم وبحمدك أشهد أن لا إله إلا أنت أستغفرك وأتوب إليك. السلام عليكم ورحمة الله وبركاته.
وعليكم السلام ورحمة الله وبركاته. السلام.
مع السلامة.